Welcome to Wealth Hustle 247 podcast, your trusted guide to financial literacy, business innovation, and entrepreneurial success. Learn how to grow your wealth, make informed decisions, and turn your ideas into profitable ventures.
Stop guessing and start winning with money. Welcome to the real rules of financial freedom in Nigeria. We're giving you the insider rules, proven strategies, and mindset hacks to take control of your finances and live free, starting today.
Welcome back to the deep dive. For so many of us, this idea of financial freedom, it feels really abstract.
It does.
It's like a lottery win or some, distant fantasy. We get bogged down in these complex theories like options trading or specific stocks when
Well,
really
the real battle is just stability.
exactly, just achieving some stability when the economy, whether it's global or local, just feels chaotic. So today, we're taking a step back. We're going right to the fundamentals, and we're focusing on a framework that was built for that exact environment, instability. We did a deep dive into a source called The Real Rules of Financial Freedom in Nigeria, and what we found was this incredibly clear 10-point system.
And it's not about maximizing gains in a boom market.
No, not at all. It's about building rock-solid, predictable stability when the ground just keeps shaking underneath you. So our mission today is to pull out those 10 core principles and really focus on building sustainable, repeatable systems.
Systems, not luck.
Exactly. It completely transcends luck.
And that geographic context, it's actually crucial, even if you don't live there. What's so fascinating is how quickly the source just dismisses all the external noise.
All the things we usually focus on.
Right. It says right at the start that financial freedom is not about hoping for luck or waiting for some huge policy change or even just, moving somewhere else. It immediately anchors true freedom in building these structured, predictable internal systems that you can control no matter what's happening on the outside.
Okay, so let's unpack this framework. And I think we had to start with the one principle that is just completely non-negotiable. It's listed as Rule 2 in the source.
But it's really Rule 0. It's the bedrock.
It is the absolute foundational bedrock. Without it, none of the other rules matter.
And that's Rule 2. Spend less than you earn.
It sounds so simple.
Ridiculously simple, yeah. Like something your grandpa would tell you. But the source really emphasizes how complex that is in today's world with high costs and...
High consumption.
Exactly. This rule isn't just about, avoiding debt. It's about generating a surplus.
That's the key word right there, surplus.
Yeah.
We're not just talking about breaking even.
Yeah.
We're talking about creating that necessary gap, that delta between what comes in and what goes out. If you can't consistently create a surplus, you literally have nothing to protect and nothing to invest.
You're just running on the treadmill forever.
Forever. And this takes rigid discipline, budgeting, intentional living, and it doesn't matter if you earn a little or a lot.
Right. And if Rule 2 is the discipline, then Rule 1 sort of defines the goal. What are we using that discipline for? And Rule 1 says, predictable cash flow matters more than big money.
And this raises a really interesting question, right? Why is predictability more valuable than just a huge income? I think we can all feel that intuitively. I mean, big money that swings wildly up and down, it forces you into this high-stress, reactive mode.
You make $1 million this month and 0 for the next 3.
Yeah. And that uncertainty, it just keeps you anxious all the time.
And the source makes this powerful argument that true freedom, it's not defined by the size of your bank account. It's defined by the level of stress in your life.
That's a great way to put it.
So in an unstable economy, a steady, reliable cash flow that consistently exceeds your monthly expenses.
Yeah.
That's the real luxury.
Yeah.
That predictability lets you plan, it lets you invest, it lets you sleep at night.
Yeah.
You're building a system on knowns, not on, guessing about next quarter's big contract.
That distinction, using stress reduction as the metric for freedom, I find that profound. It shits the whole goal.
It does.
You're no longer chasing the biggest payday. You're chasing the steadiest, most reliable payday. Now, before we get too deep into the mechanics of building this, we should probably touch on Rule 10, because it personalizes everything we're about to say.
Ah, yes.
Rule 10 is financial freedom is personal.
And it has to be. You can't just download someone else's financial template and expect it to work. The system you build has to align with your specific income.
Your responsibilities.
Your unique responsibilities, right? Whether that's supporting family or, specific business costs. And your personal risk tolerance, your long-term goals. I mean, the structure that works for a single software developer in a big city is going to be completely different from the one needed by a small business owner with a family in a rural area.
It just acknowledges that your financial life is messy and individual.
Mm-hmm.
Okay, so we've got the mindset down. Rule 2, generate that surplus.
Mm-hmm.
And we have the immediate target. Rule 1, predictable cash flow to cover expenses.
Right.
So now let's talk about allocation and growth. Where does the surplus money actually go?
This is that transition point, right, where we move from just surviving to actively building wealth. And to do that, we have to get really clear about separating our goals.
Protecting capital versus growing capital.
Exactly.
Which brings us to Rule 3. Savings protect, investments free. We tend to mush those two together.
We do. We call it all savings, but the source insists on a really rigid line between them, a delineation of purpose. Precisely. Savings are the shield, that's your emergency fund, and its only job is security, usually 6 to 12 months of living expenses.
Right.
Now, in a highly volatile economy, the source implicitly warns against just holding huge piles of cash in a local currency that's depreciating.
Because inflation is eating it alive.
It's a leaky bucket.
So how do you protect the shield itself?
You have to look for stability proxies. So that often means denominating those savings in a hard, stable currency, like the dollar, maybe through dollar-denominated funds or stable investments that act like hard currency.
The goal isn't growth.
No, not at all. It's capital preservation, pure defense. Investments, on the other hand, they're the engine. Their specific job is to beat inflation and create real growth.
Okay.
And the source gives this very stark warning. Inflation destroys idle cash. If your surplus is just sitting there, it's actively losing value every single day.
So you have to invest it wisely.
Yep.
It's not optional.
It's mandatory for survival.
And if you're building that investment engine, you need redundancy. You absolutely need it. Which brings us to Rule 4. Multiple income streams are essential.
I mean, if we connect this back to that idea of extreme economic uncertainty,
Right.
where one company or one industry or even just one political decision can wipe out your main job,
Yeah, that's terrifying.
then relying on a single source of income is, well, it's fundamentally an act of financial recklessness. True stability, true resilience, it comes from combining income from multiple different pillars.
So what does that look like in practice? Especially for someone who already has a really demanding full-time job.
It means you have to blend your active income, your salary, your main business with passive or at least semi-passive streams.
Like what?
It could be leveraging knowledge you already have, maybe through digital skills like consulting or creating content online.
Yeah.
Or it could be investment income like from our rental property or, dividend stocks. The absolute key, though, is that the streams should be as uncorrelated as possible.
So they don't all collapse at once.
Exactly. So if one pillar gets knocked down, the others are still holding the whole structure up.
That combination.
Yeah.
That really is the definition of resilience. And speaking of building things, we have to be so intentional about what we're accumulating, which is Rule 5. Assets create freedom, liabilities create stress.
It's a classic rule, but the source defines that operational difference so clearly, it just cuts through all the consumer fog.
Right.
Assets are things that pay you. They put money into your pocket, rent, interest, profit, whatever. Liabilities are things that drain you. They take money out of your pocket every single month.
For maintenance or interest or just consumption.
Right.
And we all get them confused because modern society is brilliant at framing consumption as an asset. The new car, the fancy apartment, they feel like wealth.
They feel like it, but they're powerful liabilities. The source is adamant that wealth accumulation is an ordering problem.
Like ordering problem.
You have to prioritize buying income-generating assets before you dive into luxury consumption. Build the machine that generates the cash first.
Because if you spend your capital on a depreciating liability first,
You've killed the seed. You've destroyed the opportunity for future freedom right there.
that's a really powerful way to think about it.
Yeah.
Okay, moving into this final section, we're talking about longevity, structure, we've got the money flowing. How do we make it sustainable without just burning ourselves out? And this is where we find what might be the most nuanced idea in the whole document. Rule 6, structure beats hustle.
Yeah, and I think everyone listening understands hustle. We all get it. It's what generates that initial surplus we talked about in Rule 2.
It's necessary.
It's necessary to start. But the source makes this critical point. Hustle generates income. Systems generate freedom.
Okay, but let's be real. For so many people starting out, especially in volatile markets, hustle is all they have.
Of course.
The source says to trust systems, but how does someone go from working every single hour just to survive to building a structure when they barely have enough capital to breathe?
It has to start small. Structure can just mean automating repeatable tasks with cheap digital tools. It can mean documenting your processes so they aren't all just stuck in your head.
Right.
But most importantly, it means intelligent delegation. Instead of you spending all your time on low-value tasks, you delegate them or you hire for them, even if it's just a few hours a week,
To free yourself up.
to free up your time for the high-leverage activities, the things that only you can do. Look, if you have to be physically present and driving the whole process 24/7, you haven't built a system.
You've just bought yourself a very stressful, high-paying job.
Exactly.
So we've created the flow, we've systematized the work. Now we have to protect the whole thing from a massive external shock.
The black swan event.
Which brings us to Rule 7, something I think a lot of people see as just an optional cost, especially when inflation is high. Insurance is a wealth tool.
This is such a classic case of confusing a cost with capital preservation. People drop their insurance premiums to save a little cash flow, but the source treats insurance as a non-negotiable defense mechanism. And why? Because one single catastrophic, unexpected event, a health crisis, a major accident, a fire, it can wipe out years of careful, meticulous progress.
Gone. In an instant.
Gone.
We think of insurance as this, like bureaucratic headache, but the source frames it as a tool for continuity.
Yes, that's the word.
It guarantees that your whole system doesn't have to restart from zero just because of one bad roll of the dice. It protects the structural integrity of your wealth.
And that protection is what lets the structure keep standing, which is crucial because at the end of the day, the success of that structure isn't determined by the size of the initial investment.
It's determined by the person running it.
It is, which leads us right into Rule 8. Financial literacy determines outcomes.
This one feels so important because it explains the difference between being wealthy and just earning a high income.
Absolutely. The source flat out argues that your income level does not guarantee wealth. We've all seen it, right? High income earners who are still totally broke
Every single month.
because they lack the ability to manage risk and allocate capital. True financial success is determined by the quality of your knowledge, your discipline, and your decisions. Without the literacy to understand, local real estate rules or analyze different investments or calculate the real impact of compound interest, the money just won't stick.
It's the difference between knowing what to invest in versus knowing why you're investing in it.
And understanding the risks.
Yeah, and that requires continuous self-improvement in a really competitive space. So if financial literacy is the knowledge, then Rule 9 is the application. It's the mechanism that makes sure you take action no matter how you're feeling that day. Discipline outperforms motivation.
Motivation is so fleeting. It's a feeling. You get excited after a big win or after listening to a deep dive like this,
Right.
but that energy fades. Habits, though, habits endure. The source really hammers home that consistency and long-term application are everything.
Which is why things like automated savings transfers or automated debt payments or scheduled investments are so critical.
They're your personal robot.
They are. They enforce the discipline even when your motivation is gone for the week. You're essentially building a financially disciplined robot into your own life to handle the mechanics.
Which frees up your emotional energy for the big picture, high-level decisions.
Exactly.
So if we look across all 10 rules, you can really see the path. It starts with the basic action of generating a surplus. That's Rule 2. Then it sets a clear goal, which is Rule 1. Reduce stress through stability. It prioritizes investing over consuming, diversifies your risk, and emphasizes efficiency with systems.
Protects what you built.
Protects it, demands that you keep learning, and relies on mechanical consistency to get it all done. And the whole thing is personalized to you.
That's a phenomenal summary. It's a really robust framework. And this source concludes that financial freedom, it requires patience, structure, discipline, education. But it is absolutely achievable.
For anyone willing to do the work.
For anyone. It's not about finding some secret hack. It's about executing a process consistently.
And the ultimate reward the source talks about, it's the restoration of agency. It's not just about the numbers on a spreadsheet. It's about the peace, the stability, and the control over your own financial future that these systems give you.
Yeah.
It strips away that corrosive anxiety that instability creates.
And that control. That is true freedom. So as you move forward with these 10 rules in mind, let's end on a provocative thought for you to mull over. If Rule 1, predictable cash flow, and
Mhm.
Rule 8, financial literacy are, arguably the most critical rules for building a lasting structure.
Mm.
Which one requires the most immediate behavioral shift in your daily routine?
Interesting.
Is it the discipline needed to manage that consistent flow of money to always produce a surplus?
Mm.
Or is it the time investment required to actually acquire the knowledge that will fundamentally change your decisions about where that money goes? Something to think about until the next deep dive.
That's it for today's episode of Wealth Hustle 247. Be sure to follow, like, comment, and share with others. Keep pushing toward your goals, and we'll see you in the next episode.